Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Michael Normyle. He's a U.S. economist at Nasdaq to discuss how consumer spend trends and what we're seeing in the employment report and all the inflation data, what that could mean for the Fed rate hike in February. Michael, it's great to see you as always. Welcome back to Trade Talks. And before we get into all the data, let's talk about the market. Open up strong for the beginning of 2023. First week actually in the green.
Right. So 2023, we saw a bounce on Friday following the jobs data, with major indices gaining over 2%. 10-year Treasury yields fell 10 basis points to 3.6%. And so that meant it was positive first week to 2023, which is a great start after the way last year went. So the reason we saw the bounce on Friday was because the jobs data showed that there's some easing in the labor market, which has been what the Fed wants to see, because a less tight labor market should mean that we have slower wage growth, and wage growth is a big piece of services inflation. And so the Fed has been wanting to see wage growth slow to a point that is consistent with inflation at 2%, which is wage growth around 3.5% to 4% year-over-year growth.
Yeah, and let's take a look at some of the data that came through in a more granular level, because as I had mentioned at the top, all these things do trickle down at some point, right? It could impact consumer spend trends. It could impact what happens with earnings and how much the consumer can absorb. And of course, that means how are they getting paid? Are they working? So what are you seeing in terms on a more granular level with the employment data?
Right. Well, so the first place to look to see if wage growth is slowing is wage growth, of course. And so in December, we saw wage growth slow further. It's down to 4.6% in year-over-year terms, and that's from a high of 5.6% in March of 2022. And if you look at just non-managers, that wage growth has slowed even faster. It's down to 5% from a peak of 6.7% also in March of 2022. So wage growth is coming down. It's not quite to the level where the Fed wants it at just yet, but it's getting there. And then a couple other leading indicators from the report that showed some signs of easing in the labor market are the first being temp workers. And so temp workers is an area where companies will adjust their payroll costs when the economy starts to slow. So they'll let go of temp workers first before resorting to layoffs of permanent staff. And then again, when the economy picks up, they'll hire temp workers before committing to the cost of permanent staff. And so that's something where we see temp employment tends to peak a few months before a recession begins. And so overall employment tends to peak around the beginning of a recession, more or less. And so lately, we've seen temp employment slow for 5 straight months. It's about 3.5% off of its high. Now, that doesn't necessarily mean that a recession is going to happen. We saw temp employment slow in 2015-16 and 2018-19 without a recession, which is the circles on the chart. And so the other area where we're looking at a leading indicator of the labor market is hours worked per week. And so again, that's an area where when the economy is slowing, you'll have companies reduce hours instead of laying people off. And then again, when the economy picks up, they'll increase hours before hiring people. And so for the overall economy, we've seen hours worked per week slowing, but the impact's been more pronounced in manufacturing. So that's the chart that we have here. And you can see that manufacturing work week, it's been slowing since early last year. It's now well below where it was during the last expansion. So between slowing wage growth, declining temp employment, and fewer hours worked, we have multiple signs of easing in the labor market tightness.
Yeah, it's interesting, Michael. If we could pull up that chart just one more time, when we took a look at hours worked, you could see that dip, right, into 2020 where it went to 38 hours. Is that what that is? I mean, it doesn't seem like a lot, though. It's really only 2 hours if you look at the baseline of 40. I was kind of surprised to see that. I thought it would have been a little bit more drastic. So certainly learned something new there today. But of course, as we look at our final slide here, probability of a rate hike in February, chances are it's going to happen. Just how much of a rate hike are we looking at?
Right, exactly. So, the market saw this jobs data as a sign that, wage growth is slowing and should slow further. And that gives the Fed reason to slow its rate hikes as well. And so that's why we now see an 80% chance of a 25 basis point rate hike next month. And that's up from about a 63% chance before the jobs data came out. Of course, the Fed official commentary in recent data has said that they haven't decided. They could go 25 or they could go to 50. And tomorrow's CPI data will be a factor in that too. But if we get wage growth slowing more and inflation slowing, as well as like we've seen both of them slowing lately, if that trend continues, that gives us some hope for this year where, the Fed could ease up on hikes, which would see bond yields fall. It would help equity valuations and set up the market for a more sustained rebound later in the year.
So if we were to get the 25 basis points, the market should digest that well. If in fact we do get the 50, then it could not be, a good day for the bulls, is basically what that chart is saying.
Yeah, I think you're right.
All right, Michael, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.